Hello and welcome to The Resilient Investor with me, David Stevenson. We've been away for a few months, stocking up on some good ideas to talk to you about. And our core notion is that we're going to try and explain to ordinary investors, particularly early stage investors, beginner investors, about the ins and outs, the kind of FAQs of investing in investment funds and investment trusts. And we're going to start with, I think, probably the most central question, which is, how do you invest in the whole financial sector itself? So that's the core of all investment markets, banks, big broker-dealers, asset managers. Now that might pose its own obvious question, which is, why would you invest in a sector rather than, say, global equities? So there are lots of big global equities funds out there, and they all have a diversified mix, probably many of the names you probably know, lots of global technology names, lots of industrial names, all that kind of stuff. And then you've got sector funds as well. And these sector funds can range from, say, energy sector funds, technology sector funds, could all the way to financial sector funds. So that goes back to that question. You could invest in the whole financial mechanics and workings of the global macro markets. And to understand how that works, I think we've got probably, certainly I know him to be an expert at it, the best person we can get on this, Nick Brind, who's the co-manager of the Polar Capital Global Financials Trust. Nick, welcome.
David, thank you for having me.
Now, we've known each other for many years, and for full disclosure, we have sat on a board together, so we've had many experiences in the markets. But Nick, you're the perfect person to talk to really about the financial sector. And let's start with that first question that I posed at the beginning. Why would you invest in a specific sector fund and not, say, in a broad basket of sectors as part of a global equities fund? What's that special thing that you get from investing in a sector fund, in your case financials, and we'll talk a bit more about what financials are. They're not just banks, are they? Lots of different things. Why would you invest in a sector fund, though?
It's a great question. I think, certainly in recent years, people are happier to look at thematic funds, whether that's technology, healthcare, and we'd obviously include financials within that. So the question is, why have a separate exposure to that specific sector? And in that sense, it's the second largest sector globally. It represents, behind technology, it represents about 15% of global equity markets, reflecting its importance. But also, more importantly, it's got some fantastic companies in it, which we think investors should be exposed to. Now, we can come back to this in more detail. But if you buy into the belief that interest rates are not going back to the levels that we saw post the global financial crisis or during the pandemic, then financials as a sector will make more money, and you should benefit by being, exposed to that. And then perhaps lastly, diversification. If you're lucky enough to be invested in growth via tech, the Mag 7 in the US, or the granolas in Europe, financials are a way to diversify away from that, and they're the biggest constituency of value indices.
Yeah, we'll come back to that value point a little later. Okay, so let's get under the skin of financials. Most people probably think of financials, just think banks, don't they?
Yes.
But it's more than just banks, isn't it?
Yes.
Why don't you give us a kind of roadmap of what's in the fund and how you look at the world of financials?
So it's split into three broad subsectors: banks, as you've highlighted, insurance, and diversified financials. And that hides a really, really broad sector. Payment companies.
This is the diversified basket.
This is the diversified basket. Payment companies, stock exchanges, asset managers, brokers. If you go into the insurance sector, is it what you call property and casualty insurance, non-life, or is it life assurance? Banks, is it investment banks? Is it trust banks, custody banks? Or is it
retail,
commercial banks? So it's incredibly diversified and gives you different exposures.
And there's, just on that theme about diversification, there is a tech theme to it, isn't there? So a lot of these businesses are quite tech focused. I always remember a line. I used to do quite a bit of work with HSBC, and somebody once described to me as HSBC as an enormous IT business with a bank. attached to it because it was so tech driven.
Yeah. I can't remember when this quote was, but it's probably at least 10 years old now. But NatWest used to say their busiest bank branch was the 7:35 train from Reading to London Paddington. And that just highlights just how much,
Assuming that train got there.
Yes. It just shows you how much the industry, whether it's banking, insurance, or whatever it is, has been changing in the last 10, 15 years with technology.
And we'll come back and talk a bit about fintech in a minute. So we've mapped out what the broad subsectors are. Let's just talk a little bit about the drivers. And you mentioned interest rates. So I think most kind of naive investors would look at the financials and just think, oh, it's all a function of interest rates, isn't it? And interestingly enough, interest rates in a different way, which is that if interest rates go up, that's quite good news for banks. Or is it? We'll find that one out. And if interest rates go down, that's bad news for banks. And the argument always has been that when interest rates were close to zero, that was bad news, although I would point out they still made lots of money. Yeah. But anyway, when interest rates were zero or close to zero, that was perceived as being not good. How did the interest rate dynamics play out? And are there any other drivers you should need to be aware of?
It's really good. I mean, in the short run, yes, financials or specifically banks are cyclical, so they're going to be driven by changes in the outlook for economies, and therefore interest rates and the probability of recession will impact them. But if you go back pre-GFC, low interest rates was actually really good for banks because it meant less loan losses. Yeah. Because if you're, you had a mortgage or you're a corporate loan, you're going to be paying less on it. Increase the demand for lending. So you actually found back then actually interest rates falling was good news for the sector.
Yeah, so the idea of zero-bound interest rates is as a headwind is not necessarily accurate.
Not necessarily, and to take this broader, there's many companies within the sector that have very little interest rate sensitivity. Think of the payment companies.
Yeah.
Think of some of the insurance companies. They're driven by accidents, weather-related losses, claims, etc. So it's much more nuanced.
But is it generally true that if you are in an environment where interest rates are coming down because central banks are worried about a recession or a slowdown, which arguably they are at the moment, maybe recession's pushing it, but maybe slowdown, that's not as good news for most financials?
Yes, I think that's fair to say, but with all this, it's what has already been anticipated by markets.
It's already priced in almost.
Effectively priced in. Autonomous, a research outfit, did some great research pre-pandemic, and they looked at the preceding 12 recessions in the US, and they found in 8 of them, banks underperformed in the year preceding the recession, and in 8 they actually outperformed when the recession started. So again,
okay. Which is
surprise.
counterintuitive,
Yeah.
Isn't it? Because you expect with a recession, lots of companies that go bust, defaults, that kind of people not paying their loans back.
But the reality is, it's the market. As we know, the market's a discounting mechanism. When the central banks start to cut interest rates, then if the market can see through the bottom of the downturn, they think, okay, we know how deep or how long this might be. We can then price in the probability of loan losses, or what for banks, or what's that going to do for financial markets, capital market activity, and then they start to look through that and price in a recovery. So, yes, to your sense, you're right. There's downside risk by why are central banks cutting interest rates? Probably because the outlook's weaker. But equally,
but they're not cutting rates much, though. I mean, the Bank of England has been notoriously slow at cutting interest rates.
Yes.
So it's not like we're going to go back to the old world of 0.5% interest rates anytime soon.
Yeah, and that's a big difference for the sector. If interest rates are going to stay at a more normal level, whatever normal level is, but something we're perhaps more used to pre the global financial crisis, banks, insurance companies, other financials will make more money than they did in the last 10 or so years. That means they're more profitable. All things being equal, they should trade at higher multiples.
There are other drivers as well, which ageing societies, because ageing societies by their nature tend to get older. It's in the description, but older tends to mean accumulated wealth, and that means that benefits things like the demographic transition to a savings-orientated society. Lots of pension funds, lots of asset managers. Is that a driver? Is that relevant? Is that kind of a streak through your portfolio?
Yes. So, I mean, it's this shift to demand for insurance products at the micro level. You know, you likely see maybe less demand for loans. I mean, there's a separate discussion on the whole energy transition and the demand for data centers, the amount of money that needs to go into infrastructure. But demand for advice, wealth management products, definitely there'll be winners and losers. So
interesting you mentioned that though, because I hadn't thought about that an ageing society might mean less lending.
Yes. Ultimately,
it does make sense, because
it makes sense.
Because if you're over 60, you probably don't want to be having lots of loans kicking around. Oh right, okay, so that's interesting. I'd never thought that one through. But you're obviously accumulating vast savings though as well.
But accumulating vast savings, and obviously the firms that can cater for that, should benefit.
So going back to that point about all the subsectors, also presumably technology is a driver as well. So I'm struck by the fact that I use a lot of these neo banks, these digital banks. And I love them; they're great. And I'm an avowed user of most of them. But actually, one of the most successful ones that I use, which I think is quite effective, is Chase, for instance.
Yes.
Which is not a scrappy fintech by any stretch of the imagination, because it's part of JP Morgan Chase,
Biggest bank in the world.
Biggest bank in the world, So, and presumably, again, looking at the drivers, tech is quite an important driver even for the established traditional players like JP Morgan. I think I saw some amazing statistic that JP Morgan were going to be spending for R&D in the next couple of years, something like $12 billion a year or something like that, an enormous number.
Yeah, so JP Morgan spend something like $15-16 billion a year on technology. So probably R&D over 2 years, that's quite possible. And we've never been fearful of some of these challenger banks, the Monzos, the Starlings, the Revoluts, etc. But Chase in the UK, JP Morgan, with the amount of money it can spend on that, I mean, that's a competitive threat to some of the big UK clearers.
That's exactly that. That's
I think
people look at it as a threat against Starling or Monzo, but I actually look at it as a threat against NatWest, Santander, because they're going after the basic bank accounts, aren't they? And that's technology driven, isn't it?
Yeah.
And presumably you look at those technology shifts, and they appear in your portfolio. Are there companies in your portfolio that have got where you really think, wow, that's a great technology business? So as a financial service.
Yeah,
business.
so it's a great question when you're looking, longer term. Who are going to be the winners? Who are going to be the laggards? And you can list JP Morgan, American Express, Visa, Mastercard, etc. There's some great businesses out there with great moats, competitive positions that are going to be able to invest. And so within the incumbents, who like a JP Morgan is can invest and can buy what it needs or develop it internally, and that's going to be that's what we spend our time trying to be conscious of at the back of our mind when we're thinking about where we're going to be in 5 or 10 years.
Now, we've talked a lot about kind of growth and technology and everything, but a lot of people look at financial services and they think, oh, value, it's cheap.
Yes.
Well, it's certainly cheaper than a lot of the Magnificent Seven anyway. So what does JP Morgan, as a curious side, I mean, I think most of the tech giants are trading at well above 20 times their prospective earnings. And I'm guessing that the big banks trade below that.
Yes. I mean,
I'm only guessing here.
I'm guessing off the top of my head, then you're looking at financials on average trading probably around 11 times, 12 times.
So classic kind of cheap.
Now, within that, you can find European banks and Korean and probably some Chinese state banks trading at 5, 6, or 7 times, and there'll be businesses like Mastercard and Visa and S&P and Moody's trading at 20, 25 times plus or whatever. So there's definitely a barbell within the sector.
So unpacking that value point again, You look at banks, and it's very difficult to understand what they're worth because you've got a balance sheet, and on that balance sheet, you've got lots of different things kicking around on the balance sheet. There's regulated stuff, non-regulated stuff, equity, subordinated, lots of different classes of debt and equity kicking around. It's really tricky to get a grasp of what a bank's actually worth, isn't it?
It's a good question. I mean, oversimplistically, you can look at it that, pre-global financial crisis, banks were thinly capitalized, illiquid, and at the margin, investing in toxic assets. Today, it's very different. They've got lots more capital, lots more liquidity, much more risk averse when it comes to lending, as we all know. And with the rise in interest rates in recent years, they're actually making some decent money as well. So there are a lot of different beasts. And when you're looking at a sort of normal retail bank, it's just on the asset side, it's predominantly loans. Maybe that's mortgages, some corporate loans, some credit cards, and some securities, some government bonds to hold there for liquidity. So that's very straightforward.
That's true.
And on the other side, it's obviously deposits, and you mentioned some subordinated debt, etc. It's actually not that complicated.
Okay.
But regulators, accountants don't make it easy.
No. That's not just true for banks, though, is it?
That's not true for banks. There's other areas of the market that are, even more fiendishly complicated. And if you know what to look for, it's actually relatively straightforward.
The other, again, using this point about unpacking value, understanding what value means, a lot of financial services companies pay a dividend.
Yes.
Is that important? Do you focus on that? Is that something you're interested in? And how much of a dividend, what kind of yields would you expect to be paid by financial services companies, that broad spectrum?
Yeah. So the yield on the sector is just below 3% at the moment.
Oh, right.
Now, that's because a lot of companies, as they do in other sectors, they buy back a lot of their shares. So if you included that, then probably the underlying yield is probably closer to 6.5%,
oh, wow,
maybe 7%,
okay. Wow.
because of the amount of buybacks. And so that partly reflects the valuation is low relative to other sectors. But I think there's this misnomer, about, let's say, the sector being a value trap. Over the last 10 years, it's compounded at around 9.5% per annum. So
that's not bad.
That's not bad for a value trap.
No, exactly.
And as we mentioned, when you've got companies like Berkshire Hathaway and American Express, JP Morgan.
And Berkshire Hathaway is Warren Buffett's company.
Warren
for those
Buffett,
who don't know.
That's, we do strongly argue that, and you can obviously look at the
it's mainly insurance companies. It's really it's a diversified business, but it's got a big insurance business.
So for about 55% of the business is insurance, but he's got big stakes in well-known things like, obviously, American Express as well, but Coca-Cola.
I think he's got a partnership with Heinz, don't they, on that?
Heinz, Occidental Petroleum. There's a... and Apple's his largest exposure. He's got some publicity recently. He's been selling some of that. Still owns some Bank of America. So that you're getting a big exposure to, U.S. equities.
Okay, so that's the value trap, I think, dealt with.
Yeah.
You'd probably argue it's not a trap, and you probably wouldn't deny that it's not. But you probably would think it's good value, though.
I'd say it's good value, and I suppose the other thing is it's not part of the giant growth trap we're in at the moment. So, we don't know what's going to happen. I mean, the market's very different today than what it was in 2000. The Mag 7, those are great businesses, lots of cash, generating lots of cash. But there's that piece of elastic, and at some point that piece of elastic will come back, and you've got that underpin with, if you're buying something on a low valuation, as long as it's a good business. That's
so going to that point on good business, and the good business, I suspect, is defined by its ability to grow profits,
yes,
to grow earnings. Where do you think the drivers of earnings growth are going to come from in the financial services sector over the next couple of years? And who would you identify as stocks that you get terribly excited about? Go, must have more of them.
Yeah, the drivers are varying because of the nature of the sector. It could be loan growth, it could be demand for insurance. What's the where are we in the economic cycle? Where defaults, are they rising? Are they falling? Claims on insurance companies, activity in financial markets. But ultimately, if we continue to have growth in underlying economies, that means demand for financial services just continues to grow. And, certain concerns about geopolitical risks when they, at some point, if they lapse, animal spirits come back. You'd see generally the market will and the companies in the sector will benefit off the back of that. Which ones will do best? I mean, which ones have got the competitive edge, the moats, which have succeeded? It'll probably be the same that have succeeded in the last 10 years will continue to succeed.
Because there's quite a big incumbency advantage.
There is definitely there's some great small businesses out there, but the incumbency advantage of some of these businesses that have been around 100, 150 years is definitely there. Areas that we think are interesting, we've liked the alternative asset managers. So I know you spoke to the manager of ICG Enterprise the other day. So
Intermediate Capital.
So we own that.
British company, isn't it?
It's a UK company, yes. And what's interesting about alternative asset managers versus the more traditionals like ourselves, like a Jupiter, a Fidelity, whoever, is that money's locked up.
All on long-term
limited partnership funds, perpetual vehicles. You can't take it out tomorrow. You've got daily dealing funds. People can take their money out of ourselves or other sort of the traditional asset managers, and that money can leave very quickly. And we've seen that with some of the listed peers. So you've got that locked up capital, and it continues to compound. And if you're delivering good returns to your underlying investors, then that's a great compounding. And so the likes of the Blackstones, the KKRs, and all that have continued to do very well, and giving you access to some asset classes that you can't get easily through listed markets. Whether that's obviously private credit, it's a different type of risk. Private equities, again, a different type of risk. But infrastructure, real estate debt, and so forth, and they've created quite an attractive mousetrap.
And just switching to the smaller companies to end with, fintech, I suppose a lot of people talk. So have you had any fintech exposure? And are there interesting kind of fintechy businesses that you back? Because there was a big fintech moment a few years ago.
Yes,
where everybody and their aunt was setting up a fintech business. It's slightly gone off the ball since, but it's still there. I mean, a lot of those businesses are maturing now. Are there any smaller businesses in that kind of financial and technology space that you get excited about? Yeah,
I mean, the difficult thing is there's some really interesting, good businesses out there. Maybe some of them would say there's a bit more hot air than necessarily good investments, and many of them have performed poorly since they've listed on the market. We own a couple of unquoted investments.
Right. Okay, so private businesses.
One of those is Moneybox.
Oh, yeah, which I think had a recent fundraising round and did very well, didn't it? So valuation's gone up a lot, hasn't it?
Valuation's gone up a lot. And that's a business that focuses on so it's a UK wealth and savings platform, lifetime ISAs, and that's been doing very well. So that's one we think, we expect it to continue to do so.
And a good British company too.
That helps.
Nice to finish on a patriotic note, except, of course, if you're listening and you're not in the UK. Anyway, Nick, as always, fascinated to catch up with you. And Nick is the manager of the Polar Capital Global Financials Trust, or should I say co-manager, along with a couple of colleagues. And you'll find that it's an investment trust. What's your ticker again?
I believe it's PCFT, but it might be different on other.
Yeah, PCFT, I think, is that. Yeah, so that's a ticker you can find, and it's one of the longest. I think you're the longest established financial equities trust.
I believe we're the only.
I about to say the only as well. I was literally going to say the only as well. But you've been around for a good many years. Well, as a fund.
Yes, this fund was launched in 2013, and hopefully it will continue to for many years longer.
And does it pay a yield?
So the current dividend yield's around 2.6%.
Okay.
We're trading on a mid-single-digit discount at the moment.
Which is quite a low discount, actually.
Discount.
Yeah.
And part of the reason it's worth highlighting is every 5 years we offer a 100% tender offer at NAV less
And let's explain that, because that's quite important, isn't it?
So one of the things that's been important to us is, as investors and investment trusts will sometimes get frustrated is where they
discounts
trade
and
on
those,
discounts forever and ever. And we felt when we reconstructed it back in the pandemic was we'd give investors every 5 years a liquidity option that they could get out at NAV.
So that's what the net asset value,
Net
the
asset
total
value.
assets are worth.
Total assets are worth, not that you have to sell at the share price on the day, which can obviously be very, very different. And that gives you a certainty for some larger, investors, wealth managers, that their clients can get out NAV less a small amount for cost. That next event is coming up in June next year, 2025.
Not far.
So in part, that's probably a reason why the discount has narrowed to less than some
Because
of the
people know
bigger.
they'll be able to get out at
You've got that
zero
certainty.
discount. Yeah.
What the NAV will be, well,
Who knows?
Who knows? But
Depends on the markets.
depends on the market. Depends on maybe some elections.
I was about to say, oh gosh, let's not bring up the election subject. Bad to depress all of us. Anyway, Nick, thank you very much, and hope you've enjoyed this episode of The Resilient Investor.
Thank you very much, David.